This class is going to focus on how to use our currency meter. I do go over this most days in our currency blog, the Forex blog, but I'm going to delve into it a little bit deeper in the class session I'm doing now. First of all, this has the new pivot score daily, weekly, monthly trend on it compared to the older daily, weekly, monthly trend we have. This one not only tells you the direction that the currencies are most likely to move, but it also incorporates a bit of an intensity score as well. It's not just direction, but direction plus intensity. And that's why I'm pretty much using it now versus the older daily, weekly, monthly trend, statistical trend. It also has the benefit of being able to line up on tick charts, range charts, and once you add it to your chart, it also does a pretty good job, probably 95% accurate on past bars, so you can see what the previous daily, weekly, monthly trend was as you add it to your chart. So now you don't have to leave the program running in order to see how the daily, weekly, monthly trend score changed. So basically, one of the best patterns and the highest probability pattern is when you see incredible strength, like in the yen, and then during markets don't go up or down forever. Usually there's a little bit of a pullback. You want to see, visually half or even less than half. In this case, that's probably 60% less weakness than there was strength. And when the daily, weekly, and monthly trend all line up in terms of in the same direction of where the last momentum move was, that's a trend that's very, very, very likely to continue. You have the same exact opposite pattern here. It's about half as much weakness as strength. All the time frames are up, and guess what? The strength resumes. If you can spot the exact opposite pattern, you probably are going to have over an 80% likely chance of success in a trade. It doesn't mean you're going to make 50 pips, but you might make 5 to 20 or even 30 pips. So let's look at that. At 130 right here going on 2, you have very little amount of weakness. The trend is clearly to the upside. We want to find another currency at 2 that has the opposite direction. And it probably would be in the Swiss. Weakness, not quite as much weakness as you had intensity of strength in the yen, but you can clearly see weakness coming into 2. The daily trend is just switching from up to down, and the weekly monthly trend is clearly down. So let's bring up a Swiss yen chart, and we're going to look to sell this going on 2 o'clock. This is not one of those currencies I typically leave up. This has the benefit of having just went from above the hourly moving average to below. The previous week's low is right there, and it broke through it with almost no trouble at all. Support resistance are areas where there's likely to be buying for support, and resistance is an area where there's likely to be selling. When a buy area gets penetrated like this, without even going sideways there for a few bars, it penetrated it within the first 5-minute bar. So going up to 2, you're actually looking to sell, and our intelligent trailing stop already has this as a sell. I would personally wait for it to break down underneath that low right here. And because our trailing stop already is above there, you can use that as your exit. 69 is your entry. Your stop is around 78. You're risking about 10 pips. You always want to draw your fibs on the previous swing down just to get an idea. This is your first fib target. If it stalls there, I always exit half my trade, and then the second half when the trailing stop gets hit. And you can also exit half your trade at the first fib target. If it's lucky enough to go to the second one, you exit your second trade there. You would have been out of half at 40, the other half at 23. Somewhere in the middle is your average exit price. Let's just say 32. You're short here at around 70 for almost a 40 pip move. And that's, in a nutshell, what we look to do with the currency meter. You have the same exact pattern here. You have about an hour and a half of incredible strength, followed by a pullback right here. And really, I like to see at least 3 to 5 bars of red. This is on a 5-minute chart, so there's 10 minutes of weakness, 15 minutes of strength, and then you have a little bit more weakness. And the first bar of weakness oftentimes is the most, and then it kind of subsides a little bit. You're looking to find the buy in the yen coming up to around 430, 440 right here. Which one was the weakest at that time? The pound. Unfortunately, the weekly monthly trend isn't quite that bad. Same thing with the New Zealand. Its weekly trend is up and monthly trend's pretty strongly up. The Australian really didn't have that much weakness. And you could also look for another sell in the Swiss. So since the Swiss chart's already up here, at 4 o'clock we're looking for another sell. And you can see this one makes a nice little counter trend move up right here. You could short it when the trend line gets hit, or when the trailing stop gets hit at 42, you're out right here at 22. That's a 20 pip win. Keep in mind that it only takes 10 pips per day to net 10 pips. That means if you make 15 pips on one trade and lose 5 pips on another trade, you've netted 10 pips. 10 pips a day doubles your account every 2 months using low amount of leverage. You start with a $2,000 account, you get 10 pips per day. You can see it breaks out to $40 a day at first, starting with 4 mini lots. After 2 months, 8 weeks, you have pretty much double, more than double, because it's not incrementing exactly. It's not using micro lots. It just increments by 0.1 or sometimes 0.2 lots. But you can see at the end of the year, your $2,000 account has grown to a tremendous amount based on the power of compounding. You're obviously doing 51 full standard lots. That's a tremendous lot size. You might get up to 20 lots or 30 lots and find that emotionally or psychologically you can't handle it. So there is a limitation to how fast you can grow your account as you have more and more lots. You might find it nerve-wracking to trade for $300 to $500 a pip. A 10 pip stop might be a $3,000 win or a loss. I mean, actually a stop. If you lose, you would be losing $3,000 in that case. So let's look at some other examples here. We already know that the yen is perfectly set up for the likelihood of it continuing up, and you can see the pound is probably one of the better ones to be trading other than the Swiss. So we're going to look coming up to 430 for pound yen sell. Weak pound, strong yen, and let me bring up a range chart on here. I prefer the range chart. We're going to go back to 430. So first of all, this one had gone down incredibly amount of pips today. Draw your fibs on there. And when a currency is so weak that it can't even hit the 38%, it actually adds to your probability. Here's the 430 time. It's trying to get back above the previous day's low, which is if it can do that and stay above there, it's a sign of strength. The trailing stop gets triggered right when it breaks the previous day's low, which is a wonderful thing. So you can see it's shorted here at 86. If you use our trailing stop to get out, you're out at 61, and you made about 25 pips. And notice on the build your own trend tools on the range charts, extreme weakness, no strength. Extreme weakness, almost no strength on this pullback. That's a very high probability trade. And if you wanted to get short here, you can see by just simply selling the pound versus the yen, you obviously made over 25 pips here, pretty much broke even here, short here, made 10, 15 pips. When it gets underneath the lower red 3.0 containment band, that's usually where the market's going to stop going down. You don't need to put the 1.5 band on your chart, but you really should have the 2.0 containment bands, which I like to make white, and the 3.0 bands, which I like to make green. Underneath that green 3.0 band, there's probably over a 90% chance it's going to reverse. So if you want to do counter trend trades down here, you certainly can. But that's not part of this class's discussion. Let's just scroll forward and let you see, what happens. Usually when that 3.0 band gets hit, you're going to get a multi, 10 to 50 pip counter trend move, which you can see happen here. Small profit, small profit, small profit, 20 pip profit if you just use the trailing stop to get out. Typically what I do, and this is really for another class, is I tend to scale into some big trades down there. I might I might buy 5 lots. 5 lots, it kind of goes up, comes down, doesn't break the low here. I might add 5 lots to it. Exit my trade here. It comes back down again, has a little bit less weakness. I might buy 10 lots right here. It comes up and it kind of runs out of steam. I might exit half of those 5 lots, and then on the second wave up, I'm looking to get out of the whole trade here at 70. But by doing that, and I'll scale sometimes into 30 full lots there. If it continues on against me, I'll scale in progressively so that most of the time, if it only moves 10 pips my way, I can get out of the trade at break even, which is usually the worst case scenario I run into. It's been really about 4 or 5 years since I've ever got zinged doing that in the 3.0 containment band. Is one of my staples of, for my own personal trading. I love it. It works the majority of the time for me. And, if you have a loss, another loss, and then you get a 30 pip win on a huge position, you've got your loss back. Let's look at another pattern other than the yen. Here you have some weakness, and here you have a little bit of strength. It's not the perfect pattern, whereas extreme weakness and then visually half as much, extreme strength and visually half as much weakness here. You know, those perfect patterns don't come along that well. But you can also look for time. Here, 2 hours it went down, 15 minutes went up, and you can see, let me hit the plus key so you can zoom on this. A little bit of strength, decent strength, a little bit less, a little bit less. As it starts going down there, and the daily trend's extremely weak, the weekly trend has also been weak, and the monthly trend's kind of mixed. It's really not up that much. It's pretty safe to assume that we're going to have some weakness come back in the CAD here. And you can, coming up to 10 o'clock, try to find, one of the stronger ones. We already did the yen, so I'll look at the dollar here. We're looking to buy the dollar CAD coming up, slightly before 10. Let me bring up our range chart on here and hit the plus key and zoom out. Here's 10 o'clock. This one is right at the previous week's high. It found some resistance, pulled back. The trailing stops underneath your chart here, and it breaks out. Coming up to 10 right here, 10:03, you're in, right around the whole number. And most of the time it's going to go to the fib target. If it stalls at the first one, I will usually exit half here. If it stalls at the second one, I tend to exit the whole thing if I haven't already exited half. And this one went above the 1.618, so I'm really expecting it to kind of run out of steam. It went right to the previous month's high. We're above the 3.0 band, which remember is the majority of the time the end of the move, and you're out pretty much right here at 1.033. You're in this trade somewhere around 04. So it's almost a 30 pip win. And once you get into a trade, if you see this spike to 80 and plus, you want to stay with it. You can always move your stop up underneath the previous 6 pips per bar's low. So you're always trailing your stop by 6 pips. And whenever there's this kind of momentum, it usually takes off and continues.